And still, the debate goes on as to whether the US economy is going to suffer a hard landing, enjoy a soft one, or even float along, keep growing and avoid a recession altogether. Some are now arguing the Federal Reserve has raised interest rates too far too fast, and that the banking sector wobble will detract from growth as senior loan officers turn more cautious on lending policies. Others will point to the strong jobs market, low unemployment and decent wage growth as signs that the US economy is still powering along, thank you very much. Now, this is a slightly dangerous argument since job data is really a lagging indicator, and it's one that will be put to the test in the coming week by two sets of figures stateside. The first is the Job Openings and Labour Turnover Survey, or JOLTS. That's due out on Tuesday the 4th of April. The headline figure here will be the job vacancies in the USA, which is still very, very high by historic standards to suggest that employers cannot find the staff they need, and that is usually a sign of a strong economy. In January, the number of vacancies dipped by 400,000, but still came in at 10.8 million. Bears will say that's below the March 2022 peak of 12 million. Bulls will say it's higher than normal for the 20-year history of the dataset, and also miles above the 7.1 million vacancies on offer in 2020, just before COVID struck. The second dataset, due on Friday the 7th, is the latest batch of non-farm payrolls, unemployment, and wage growth figures in America. Now, this year has started strongly, with 504,000 non-farm-based jobs added in January and another 311,000 in February. Economists will look to the March number and also any revisions to the January and February figures to take the temperature of the American economy. Upward revisions usually indicate strength. Downward revisions can be suggestive of a weakening or loss of economic momentum. The unemployment rate last time around was a lowly 3.6%, to again point to a strong economy. And the average hourly wage in America grew to $33.09, a 4.6% year-on-year increase. That represented a slight acceleration in the rate of wage growth and may have had policymakers slightly on edge when it comes to inflation. It may even have been one reason why the US Federal Reserve therefore elected to hike the Fed funds rate by 0.25% to 5% at its March meeting. From a bottom-up perspective, the shortened week in the run-up to Easter means the slate of scheduled corporate announcements is relatively quiet, with nothing due from FTSE 100 members except Rio Tinto's annual general meeting. Results or trading updates from the following firms may still, however, be worthy of further research, although do note that some of these dates could yet be subject to change. Renew Holdings and Traxys on Monday the 3rd of April, Sage, Medica, Gooch and Housego on the 4th, Lookers, Enquest and Topps Tiles on the 5th, and Ferrexpo on the 6th. But another company that's due to report just before Easter weekend is the one that could cause the biggest fuss. Robert Walters is due to report a first quarter trading update on Thursday the 6th of April. The FTSE All-Share Index member is a recruitment specialist, so this takes us back to the issue of jobs. Again, we have to accept that jobs data comes with an inbuilt lag because it takes companies time to build up to and then get on with hiring, let alone go through the process of interviewing and choosing the right candidate and then getting them to sign on the dotted line. That caveat aside, this update should be informative, not least because Robert Walters, the company, reported record profits in 2022. It also announced a double-digit percentage increase in its dividend and even ran a share buyback for good measure. Eponymous Chief Executive Robert Walters, who will actually step down at April's annual general meeting to be replaced by Toby Falston after 38 years at the helm, well, he had flagged fierce competition for candidates and strong wage growth to match in the first half of last year. However, he then noted increased uncertainty in the second 6 months, thanks to rate hikes, the ongoing war in Ukraine, and spending cutbacks in the technology sector in particular. Analysts and shareholders will be looking for an update on these trends, especially as the shares are down by a third over the past year and are actually making pretty heavy weather of forging anything like a recovery. Remember that in the fourth and final quarter of 2022, fee income grew 11% year on year. Now that wasn't bad, but it did end a run of 6 consecutive quarters of 20% plus growth. Within that headline figure, analysts will then go to the regions. Europe showed the fastest growth in the fourth quarter, followed by the UK and then Asia Pacific. Asia Pacific being held back still then by China, where lockdowns were continuing to prevail. Be interesting, therefore, to see if that trend is reversing now. One other useful indicator is headcount. If Robert Walters, the company, thinks there's business to be won and done, it'll hire more staff of its own. In 2022, headcount rose by a quarter to 4,356 staff. And should management give any guidance for earnings for the full year, the current analyst consensus forecast is looking for pre-tax income of £50 million, down from £55.6 million in 2022. I hope that you and your families are in good health and good spirits. Thank you for watching, and I look forward to seeing you next time.